Many Australian retirees believe the smartest move in retirement is to leave their super untouched for as long as possible while living off cash sitting in the bank. It sounds prudent and protective, but once you reach pension age at 67, Centrelink treats your super and your cash savings account identically. Every $1,000 of excess accessible assets above the threshold costs you $78 a year in reduced age pension benefits. Understanding the strategic order to spend your retirement dollars across super, pension income, and cash savings is critical to maximizing your wealth. The first rule comes down to mandatory super drawdowns. Once you convert your super balance into an account-based pension, the Australian government legally obliges you to withdraw a minimum percentage every financial year. For retirees aged 65 to 74, that minimum is 5%, and the rate gradually climbs higher as you age. If you fail to draw out the required amount before June 30th, your pension account risks losing its tax-free earning status. Furthermore, mid-year lump sum withdrawals treated as partial commutations often do not count toward your required minimum, catching many retirees completely off guard. At the same time, super offers unrivaled tax efficiency. Inside a retirement phase account, earnings are taxed at 0%, and post-60 withdrawals are tax-free. Money sitting in a standard bank account generates interest income that gets taxed at your personal marginal tax rate, even though senior tax offsets offer some relief. From a purely tax-focused perspective, keeping as much capital inside the super environment as possible works in your favor. However, Centrelink's asset taper rate creates an opposing pressure. Once your total accessible assets exceed the threshold, your age pension entitlement reduces by $3 per fortnight for every $1,000 over the limit. That $78 annual penalty represents an effective 7.8% drag on cash, earning low interest rates. Holding an oversized cash stockpile in an everyday bank account simply penalizes your pension payout while delivering very little return. This does not mean holding cash is bad, rather, an unplanned hoard of cash is problematic. A deliberate cash buffer protects you against sequence of returns risk. When financial markets experience a downturn early in retirement, a dedicated cash buffer enables you to cover daily living expenses without liquidating growth assets at discounted prices. Combined with the reliable, twice-indexed age pension, this cash cushion keeps your retirement plan resilient during volatile periods. Finally, estate planning rules flip the spending hierarchy once again. Money remaining in a standard bank account passes to non-dependent adult children tax-free. In contrast, the taxable component of super paid to adult children is subject to a 17% tax penalty, including the Medicare levy. Spending taxable super during your lifetime ensures those funds are enjoyed tax-free rather than taxed heavily upon death. To bring order to your retirement spending, conduct a simple 3-number audit. Calculate your mandatory super drawdown for the financial year, estimate your age pension entitlement, and compare that combined figure against your actual annual living costs. If your drawdown and pension already cover your spending needs, holding extra unallocated cash is actively eroding your pension income. After age 67, Centrelink treats your super and bank account as one and the same. What truly matters is structuring your withdrawals so every dollar works efficiently.